Many investors are on the lookout to find where the next black swan might come from that could take down the markets. And it looks like it might be hiding in plain sight in the junk bond market. Basically, you have companies that have, number one, a high amount of debt. Number two, they have debt at very high interest rates. And number three, they have overstated their future earnings to the point where they may not be able to repay their debt. According to a recent report by S&P Global, there is a fake earnings risk that is masking the overall market risk from a bunch of these debt-laden companies. Now, risk in the junk bond market is nothing new, but in the fallout that happened in the beginning of 2020 and how monetary and fiscal policymakers decided to handle it, this gave many of these companies an easy way out, or at least an easy way to delay the consequences of their poor financial decisions, at least until now. Recently, S&P Global analyzed every speculative grade company that announced an acquisition in 2019. They found 97% of them, all but 3%, failed to hit their target for EBITDA. For those of you who aren't aware, EBITDA is an acronym that stands for earnings before interest, taxes, deduction, and amortization. And yes, as you might expect, this number is a little bit easy to manipulate if you want to send the signal that you are going to be doing better than you might actually be able to do. This number has been mocked as a marketing gimmick. Because of this, the SEC actually requires listed companies to show how they arrived at their EBITDA numbers and forbids them from reporting this number on a per share basis. Because of how easy it is for this number to be manipulated and how much easy money was flowing during 2020 and 2021, it looks like there's a reckoning coming in the junk bond market. One credit analyst said that most US speculative grade corporate issuers, aka junk bond issuers, cannot come close to achieving the earnings projections presented in their marketing materials at deal inception. And like I said earlier, this is nothing new. This was all coming to a head in 2019 from the bad deals made in 2017 and 2018 before the Fed came in and rescued everything. In 2017, as many as 93% of speculative grade issuers and 96% from 2018 failed to meet their earnings targets a year later. And it gets worse. Even after the economy was flooded with all the money the Fed printed, about 77% of buyouts and acquisitions from 2019 were still short of their projected earnings. So it did help many of these companies, but obviously it wasn't enough. You can't print over a bad deal. We can see what happened to the junk bond market by looking at the price per share chart of HYG, which is a high yield bond ETF. Obviously, at the beginning of 2020, the stock price just absolutely crashed. But once the Fed started printing a bunch of money, there was an epic comeback all the way back up to the levels it was trading at before. Now keep in mind, this was illegal for the Federal Reserve to do. The Federal Reserve, by law, can only own two things on its balance sheet. One of them is US government debt, like treasuries. The other one is mortgage-backed securities. They are not allowed to own corporate debt, whether it's high yield or investment grade, on their balance sheet. So how did they get around this rule? They had the government, through the US Treasury, create something called special purpose vehicles. So basically the Treasury, under Yellen, they just set up accounts. Well, they didn't have any money to fund these accounts, so they got it directly from the Federal Reserve. So the Fed printed money, gave it to the Treasury, and the Treasury then used those dollars to go out there and buy bond funds like HYG. I've used this analogy in the past, but this is very much like the 18-year-old who wants to go buy liquor, and so he gives money to his 21-year-old cousin, goes in the store, buys it for him, and then hands him the alcohol outside the store. It's like, it's still illegal. You were the one that purchased it, but you just got around it through a little bit of a loophole by letting somebody else make the purchase for you. it's still the same net effect. And the effect of that is exactly what you see right here, which is that junk bonds were not accurately representing their true value because you had a money printer coming in and buying them all up. And obviously we know what happened next, because at the end of 2021, the Federal Reserve announced the end of their quantitative easing and said, we're going to start hiking rates. We're going to start increasing the amount that we let come off of our balance sheet. We're going to stop buying assets. We're going to make things tighter. And that's exactly when things started to fall apart again for junk bonds. And now at least this ETF, HYG, is trading at or near the levels it was at when things started to fall apart in 2020. But this is just the beginning. Why? The defaults haven't even started yet. And so if this is true, you would expect big money to have already started to try and get out of this kind of debt. And that's exactly what we're seeing right now, with banks trying to exit junk bonds given the recent increase in junk bond pricing. And this little rally is what they're referring to here. They have a ton of leveraged buyout debt stuck on their balance sheets, and given the recent rally, they're hoping to be able to get rid of some of it. Why would they be trying to get rid of it right now at these historically depressed prices if they're losing money on it? If they bought it at a much higher price, it's down right now, why would they be trying to sell it? Well, the answer is because it's debt, which means the risk is 100% default, which means you can either take a small haircut or you can hold it and potentially wind up with nothing. And that's exactly what happens to companies that say, hey, we're going to be able to make this much amount of money, and then they don't make it. But in order to do that, they took out a ton of debt at crazy high interest rates. Well, guess what? They're going to default. They're not going to be able to pay that debt back. Because if you don't have money left over after doing your business, then you're not going to be able to have anything to spend on paying off that debt. And unfortunately for these companies, they're not like the US government. They can't just keep on borrowing at higher and higher rates in order to pay back their debt that they borrowed previously. And so given market movements over the last month or so, banks are looking at potentially being able to sell off this paper at prices that are better than they would have been able to a few weeks ago. And we know that big money makes the moves in the markets. And so when we see big money like the banks trying to get out of this junk debt, there's a reason for it. When they're selling it at 91 cents on the dollar, losing 9%, there's a reason for that, because it's better than what they know the alternative will be if they hang on to it. And as one final reminder about the future of inflation versus deflation, a bunch of defaults are heavily deflationary for an economy. This is called a deflationary death spiral, where there's not enough income coming in to pay the expenses. You have debt defaults. Now there's not enough expenses to be working its way throughout the economy for other people's incomes, and it feeds back in on itself and increases the problem. So unfortunately, yes, it does look like there's more pain ahead. And if you would like to know how I invest during bear markets, being able to analyze companies, my favorite companies, and figure out whether they're actually on sale or whether they've just fallen 10% but still need to go down a lot more before they're actually a good price, you need my bear market investing guide linked in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.